Let's move on because there are things to talk about other than Bitcoin. So let's talk about bonds because you have an ETF. We're talking about the WisdomTree Bianco Total Return Fund. The ticker there is WTBN. And I think it's interesting. So this is a bond fund, but you don't actually hold the cash bonds themselves. You chose to get your exposure by holding other ETFs. Talk to us about that decision and structuring the portfolio that way.
So the portfolio is structured as an index, the Bianco Total Return Index, BTRINDX on your Bloomberg. And we discretionarily manage that index by, picking the correct rate, or what we hope is the correct durations and weightings on corporates and mortgages, and out of index bets, like we currently have a 20% weighting in short-term tips as well. Well, when we went through and we decided how we're going to structure this portfolio, we looked at the ETF community, and there's 500 fixed income ETFs with $600 billion of assets. And they're getting very cheap, and they're getting very efficient. And we said, I could do this. I could do this by buying thousands of bonds, or I could do this by buying a couple of dozen ETFs and having a universe of maybe 75 or 80 ETFs. And there's a lot of equity funds that do this. But I think the bond market has been kind of sliced and diced up to the point where this has become very, very efficient. Our average cost of all the ETFs we own right now is 4 basis points. So it has become, it's either that or put together an infrastructure to buy thousands of bonds. It's actually almost cheaper in order to, and pass that along to the ultimate users to use ETFs. Equities have done this for a while, and now I think fixed income is doing it.
And Jim, looking at the portfolio, just glancing at it, looks like it's more on the short end of the curve. You got some intermediate, one long term, but it's only a 3% weighting. Last year, we saw this massive rush of flows into TLT, which I mentioned earlier. TLT was like stuck at number 3 or 2 on the year-to-date chart almost the whole year. What's your take on that trade? It didn't work. It worked for a little bit. Now it's kind of gone sideways. Seems like a tempting trade. You don't really own much of it. What's the thought behind that?
Yeah, I'm bearish on bonds. And so, here I am pitching a long-only index and I'm bearish on bonds. But then that's kind of the point, is that by positioning correctly, you'll hopefully be on the right side. I think inflation is going to be sticky and the economy is going to stay strong. And I think you've seen it, what you mentioned about the weekly flows, that all the bonds have disappeared because rates have gone up on the 10-year to 4.3%. And I think you're seeing a lot of investors starting to pull back on that. So we are positioned short duration versus our benchmark index. We are positioned slightly underweight corporate bonds. We just did that in the last couple of weeks after the big rush of issuance in January and the all-time high in stocks. I think that, there's some pullback on that. We're underweight on mortgages and structure, but we're moving more towards an overweight. And if I'm right and rates go up, we'll probably start getting longer and longer as rates get higher. But I think the next move is going to be higher. And so we've been outperforming the index, or we've been outperforming the accepted benchmarks this year. And even though we're down on the year, and I think we're positioning ourselves well that when we get through this up cycle in rates, we'll be ready to actually have some positive return later this year.
Right.